We are in the business of needing to take risks. Without risk, there is no return, as I think everyone agrees. But that can be a dangerous thing for individuals on the team, or even for the team itself. The fear that if a risk goes bad, your career or your business is going to be impaired. And so we've been, I think, very thoughtful from the beginning of structuring this team and this process in a way that presents a, call it safe, controlled environment to take risk. And an environment that encourages investors on the team to develop as risk takers, to become better at identifying the good risks and taking those risks and avoiding the bad risks. So how have we done that? The process builds in some guardrails to begin with in a few ways. First, we only want to invest in higher quality businesses. And second, we only want to own stocks that we can prove to ourselves are reasonably valued. When you do that, you do, in our opinion, narrow the range of bad outcomes. So we're going to be wrong. We make mistakes every day and every year. The key is that when you do make a mistake, you walk away from it. And for an example, a high quality business with a great balance sheet, it has a different bad outcome than a heavily leveraged low quality business that can go down catastrophically. So we set that guardrail first to make it safe to play in this environment. Secondly, the way we allocate capital allows people to take risk and introduce stocks into the portfolio, but in a small way. So we start with a new investment idea with a small position, because we're coming to that stock knowing it less well than the existing holdings in the portfolio, and because we're trying to be very early before a company's profits are cycling up. And so we're taking a risk that we're just wrong, and the catalyst that we're expecting is not going to play out. And so we design it so that position is small, so when we are wrong, it doesn't impair the overall portfolio.